Home prices have been soaring for the last 2 years, and the number of people that have been waiting on the sidelines is just about every single person in the comment sections for whatever YouTube video is associated with housing, saying they can't wait for the crash. I personally can't wait for a crash as well, and people have been saying since 2015 that there is going to be some type of real estate market crash, which of course there'll be a crash. Everything goes up and everything goes down. And if you look at Redfin data, the home prices were really rocketing, and recently they've started to level off in price. And something that is definitely going to happen is the Federal Reserve will increase interest rates, which will then increase mortgage interest rates, which will give buyers far less purchasing power. If interest rates increase, people will be able to afford less of a home because monthly payments will go up, as well as the fact they will be told they can afford less homes because they will be pre-approved for less by whatever mortgage lender they go through. So in real estate, there's a rule of thumb that if interest rates increase by 1 percentage point, then prices will decrease by 10%. And that is just a rule of thumb. And we'll take a look at that if a home is worth $300,000, or if you have a $300,000 loan, we go on bankrate.com, check out their mortgage calculator. So we have that $300,000 loan at a 3% interest rate. We have a $1,264 payment. And now let's change that to a 4% interest rate, and all of a sudden we have a $1,432 monthly mortgage. And that's a $167 difference, which obviously gives that buyer far less purchasing power. So if you have to decrease that home by 10% in value, that's when you then get the same monthly payment. So that's really where that rule of thumb comes into play. But in the real world, things do not necessarily happen that way. Personally, I do not like rules of thumb, especially rules of thumb associated with real estate and prices and economics. Sure, it can give you an idea that if interest rates go up, then other things will go down, but there are so many other factors at play here. But one thing that is definitely true is that the Fed will increase interest rates. Now, the Federal Reserve rate and mortgage interest rates are tied pretty heavily, but they are not one-to-one, they are not the exact same. But typically when the Federal Reserve increases those interest rates, mortgage interest rates will also increase. And the Fed is planning on increasing those interest rates up until 2024 by about 1.5%. So you can just think right there, the amount of home value will decrease just purely based off of that interest rate and all else being equal. So with the eviction boom looming, as well as forbearance and foreclosures coming in, and the property developers who are taking on far too much debt and not able to pay back their loans, that 10, 20, 30%, hundreds of thousands of dollars in equity and appreciation that you've earned in the past couple of years might get completely wiped out. And the Canadian in me has to say to your appreciation, well, I think you're right there, bud, aren't you? So I've said this all along, but I don't believe there's going to be a huge substantial crash in the market. I do believe that there is going to be some type of correction, but I don't think that means it's going to go down a -10, -20% the same way that it went up. I believe it's going to taper off and slow down a little bit and become a little bit more normalized and make more sense for the real world. There's still a shortage of 5 million homes in the supply of housing in the housing market. There are much tighter lending standards than 2008. If you want to liken this to 2008, back in 2008, you could go to a lender and say, hey, I want a house. And they would say, do you have an income or a job or have any assets? You would say no. And they'd say, cool, here's a house. Make sure you pay back that mortgage. And that really was all it was. As well, in the last couple of years, people have saved more money than they ever have. People have been able to spend less money because they've been at home and they've changed their lifestyle, so they've not spent nearly as much money, and then they learn to invest and save a lot more. As well as there are all those people in the YouTube comments section that have said they've been waiting on those sidelines. And those people, because they've been waiting, have had the ability to also save more. So there is still a bunch of demand out there, there's still low supply, and you can't just get a loan and default on your mortgage because you're anybody, and lending standards are a lot more difficult than they once were. But like I said, home values will not increase the same way that they have been. They will not rocket to the moon the same way Jeff Bezos did. We are going to see some type of correction. If you're still going to be waiting on the sidelines for a substantial crash that will actually make a difference to your down payment, that will actually make a difference to your monthly payment, then you should go hook up with Marty McFly, hop in that DeLorean, go back to 2011 and buy literally any house, because back then, every home that you could possibly buy would be a good deal. My rule of thumb for those interest rates didn't take into account the fact that there could still be appreciation of those houses. They could still increase at the rate that interest rates are increasing and offset any of those negative values because there are those with less purchasing power. Like I said, there's all those factors, the shortage of housing, people saving and investing and learning how to be better with their money, so they also have more purchasing power, which will offset those interest rates. So those are all things that we'll take into account. But I 1000% guarantee, and this is not a guarantee, that if you purchased a house hack where the numbers made sense and you were able to live for free by buying a 2 to 4 unit multifamily property, renting out all of the excess bedrooms and the excess units, then you would probably be doing just fine and better off than if you waited. Because if you waited, you wouldn't have those 2, 3, 4 years of no housing payment, you wouldn't have that principal pay down, and you wouldn't have the ability to have that investment property come 2, 3, 4 years later when those housing prices eventually crash and your rent is still holding on to that mortgage of that 2 to 4 unit multifamily, and then you go buy a house for less money if that's what happens and the housing market does crash. So now you have an investment property and you're smart and you bought a house worth less money than it was 4 years ago, rather than just waiting and buying a house for less and not getting any of that benefit. And if you want to learn more about house hacking, I did a video all about it up in the description here or down below. That's not a description, but who cares? You get the point. Really, the point for me always is, and this is just really what you should go back to, is that time in the market is always far better than timing the market. If you look at a broad horizon, it will increase in value over time. If you just think in the long term, it really doesn't matter when you actually purchase that house. If you can afford the payments, if you can get through it with the rent that you're getting, doesn't matter. Everything will work out pretty well. If you look at the 2 properties that I purchased, for example, the 2 multifamily properties just outside of Boston, we can figure out that it's a very market dependent. That rule of thumb that I stated is not necessarily what is going to happen in one market versus the other. Just because it goes down 10% somewhere else doesn't mean it'll go down 10% in that other place. If you look at Las Vegas in 2008, those home values completely wiped out. People could not afford their payments, as well as their home values were worth less than what they had to pay on their mortgage, so it forced them to sell. Really, that is what will cause some type of crash. But again, lending standards, whatever. But if you look at some other markets, the home values did not crash because there were a lot of those external factors at play that play a role into the value of homes. People are willing to pay for what they think the home is worth. And if they want to live in an area because the location is good, because it's easier for them to get to their job, because the schools are good, they're always going to be willing to pay for that home. So that is really important to think about, that population growth, that there's a diverse economy in the area, healthcare jobs, finance jobs, biotech jobs, just tech jobs, whatever type of industry, as long as there's multiple of them, it's probably going to be okay. And going back to where I purchased my buildings, I see that there's a crazy amount of development happening. There are just a number of big buildings coming up, nice apartment complexes. They are taking a bunch of the industrial land in the area and turning it into green space, big shopping centers, as well as making it more accessible for you to commute downtown. So that area is going to be hit a lot different than somewhere in the rural Midwest. But even if you did buy in that rural Midwest area and you bought at the top of the market, it really doesn't matter, in my opinion, if you're willing to hold long enough and there's still some value in that area. I can't say that you can buy anywhere you want and it will increase over a 30, 40 year period. If you buy in an area that is desirable, then it should increase. But if you look at a town like Millinocket, Maine, in the middle of Maine, they had a huge booming mining town, and then all of a sudden, when that was no longer in existence and that one industry in the area collapsed, the whole town collapsed. So if you bought in the boom of that time period, which was 20, 30 years ago, the home prices were probably worth more than they are today. So I'm not going to say that every home price will increase, but if you buy a home with the idea that you can afford the monthly payment, or your tenants can handle that monthly payment, even if things decrease by 10%, the rents decrease by 10%, then you should be okay in the long run. But a majority of people, when they go into purchasing a home, do not think about it as an investment. They're just told that it's an investment, and then they pay the bank back, and then the bank gets more rich. But whatever, none of that is important in today's video. Today's video is all about the fact that timing the market is not nearly as important as time in the market. If you can just buy a home where the numbers make sense and you can afford the payments, then you can get through any of these negative cycles if they come up. And if you bought a home with the understanding that if someone rented it out, it would still cash flow or would still break even, or you could still afford it if it was negative, then if it actually truly did crash the market, then you could then go buy another house, move out of the one you're in, rent it out, and then dollar cost average into purchasing rental property or into purchasing property in general, rather than taking that home that you could no longer afford the monthly payment of, selling it at a loss, and then buying a different home. It's really just the worst thing that you can do. If you go into it with the right mindset, you're going to be good and everything is going to be all right in the long run. So interest rates could go up. This could make a huge difference in home values, and there could be a bunch of other factors at play, but in my opinion, this really is all just noise. And as I would say, well, oh yeah, a deal is a deal, eh? Isn't it? Really, I think that's always going to be true, and I'm doing pretty well with my accents here today, but a deal is a deal is a deal. If it's a deal, it's a deal. How many times can I say deal? Deal or no deal? So I'm really curious what you guys think. Go ahead, put it in the comments below if you think we're about to have a crash, or if you've been waiting, or maybe now you're motivated to stop waiting and go ahead and buy that house hack and watch my video on house hacking so you actually know what that's all about. And if you really enjoyed my video, I'd appreciate it if you subscribe if you haven't already. I like talking about real estate, I like talking about personal finance, and teaching people how they can build their wealth. And don't forget to smash that like button as well, because it really helps the YouTube algorithm and push this video to more people. And if you thought I was cool here, you might think that I'm somewhat cool on Instagram, so go ahead, check that out as well. So thanks again for watching, and hope to see you guys next time.